Most of us avoid any sort of debt at all costs, even if it means delaying your real estate investments. But with careful planning and discipline, I'll show you how getting a home loan and why a longer-term loan can maximize your gains. I'm Edric Magwan, and this is The Real Deal! Welcome to my channel. I'll be sharing with you real stories and practical investment strategies so you can have the confidence to start and grow your real estate investments today. When it comes to real estate investments, undoubtedly, the aspect that people fear the most is the loan. But remember, not all debts are the same. There are bad debts and there are good debts. And when you learn to distinguish between the two, you'll realize that debts, when used carefully, can actually give you huge financial gains. So what's the difference between bad debts and good debts? Bad debts are about living beyond your means and are generally incurred to buy things that quickly depreciate or lose value over time. In this scenario, the debt is really just a liability. On the other hand, good debts, like home loans, are about multiplying your means. You use debt to invest in assets that will appreciate in value more than the cost of borrowing the money. In this scenario, the debt is used as a leverage. For example, you invest in a condo unit with a compounded annual growth rate of 15%, using a loan with only 6% interest rate per annum. Now the question is, which is better, a shorter term or a longer term loan? At the surface level, a shorter term loan seems better than a longer term loan because you will incur less interest in total. But with a longer term loan, you will have more cash in your pocket, which you can use to invest in more properties to accelerate your gains. Let's take the following example. Let's say you take a loan of 5 million pesos for property X with a 6% interest rate fixed for 5 years. You are deciding whether to get a 10-year loan or a 20-year loan. Your monthly amortization under the 10-year loan is 55,500. while your monthly amortization under the 20-year loan is 35,800. This means that under the 20-year loan, you would have an additional free cash of 19,700 per month, which you can invest in another pre-selling condo unit, Property Y, worth 5 million. After 5 years, your cumulative interest paid for Property X under the 10-year loan is 1.2 million, while 1.4 million under the 20-year loan, a difference of 200,000. At the same time, Property Y has appreciated by 10% annually, or equivalent to 3 million. Therefore, your additional gain for acquiring another property is so much higher than the additional interest from the longer-term loan. As long as you invest in locations or developments with high growth potential and you know you can pay the monthly amortization, then the interest should not stop you from investing. So instead of avoiding home loans, tackle it responsibly and use it to your maximum advantage. For more property investment tips, click the subscribe button. And if you need help in getting the right property investment for you, sign up for a free consultation with me via the link in the description. See you guys next time!